Welcome to this installment of Clarifying Tax Situations with attorney and CPA David W. Klossing.
What exactly is Bitcoin? What exactly is cryptocurrency? Well, let me explain. Back in 2009, an individual using an alias of Satoshi Nakamoto claims to have invented something called Bitcoin. The idea was they were looking for a decentralized virtual currency. Well, they were quite successful at this. To date, Bitcoin can be transferred without a central bank. There's no clearinghouse involved, there's no administrator, and this has, on the one hand, successfully drastically reduced transaction fees and other charges. Matter of fact, my firm has the ability to be paid in cryptocurrency, and there's only a 1% transaction fee for that, where if somebody pays me on a credit card, that could be between 2 and 4% transaction fee. With no central authority being involved, Bitcoin and cryptocurrency in general gives consumers the ability to freely and directly choose with whom they want to interact. And the problem with that is this is giving rise to money laundering concerns. If you do business through a bank or through a credit card company, they're required to look for suspicious activity and do suspicious activity reporting. There's a whole bunch of things that banks are required to do that to date the cryptocurrency companies aren't doing, either by choice or they're side-skirting the law. Transactions are largely conducted between two parties, a buyer and a seller, through different exchanges that are out there of cryptocurrency. Transactions are conducted directly between the sender and receiver, and they're verified via network nodes that are all over the planet. They're dispersed using something called blockchain technology and a public ledger. Each transaction is verified through a process called mining, where somebody is charged with proving that there's only one use of a digital coin and there's not a duplicate use going on. And this process is called mining. The people who provide this service are paid often in cryptocurrency for that service. The mining process involves solving increasingly complicated mathematical formulas and equations to authenticate transfers, and again, they're compensated in cryptocurrency. To date, 15 million Bitcoins have been mined. As of March 2016, the average price of Bitcoin was $415 a coin. The idea with Bitcoin that's supposed to drive the value is there's a finite number of coins that could be mined. The idea is that there's more demand for these coins than there are supply, which is driving the price up. That's just how it's supposed to work in theory. A finite number of Bitcoins are available to be generated through the mining process. This is to be capped at 21 million coins. Experts anticipate that the last Bitcoin will be issued in the year 2140. As of November 2nd, 2017, 16,700,000 Bitcoins are in circulation, and each coin is valued at $17,664.99. That's a hell of a lot of growth between $415 a coin and $17,000 and change a coin. While Bitcoin is just one type of cryptocurrency, there are competitors out there like Litecoin, Dogecoin, Purecoin, Quark, NXT, many others, Alt, Ethereum, etc. Bitcoin, and all cryptocurrency for that matter, functions off of a widely dispersed public ledger that's published the world over. What is private about that ledger are the keys that allow people to actually get at their electronic currency. These keys are kept in an electronic wallet, which can be on a laptop, it can be on a phone, I've even seen it on a flash drive. To date, all 21 million Bitcoins have not been discovered. Miners get paid in Bitcoin, which injects more Bitcoin into circulation. What is actually occurring during the mining process is that miners are choosing to contribute computing power in order to maintain the public ledger, the blockchain ledger, that contains all Bitcoins and all Bitcoin transactions that have ever been conducted. The work they perform is vital to keeping the Bitcoin network running and functioning as expected, And again, miners are rewarded in Bitcoin. It goes without saying that individuals, businesses, and miners that either accept Bitcoin or get paid in Bitcoin are expected to pay taxes on this income. Code Section 61 defines income from all sources derived. Any accession to wealth is currently taxable in the year received. With the government defining Bitcoin as property, unfortunately a side effect of that is fastidious record-keeping requirements that are placed upon anybody that invests or receives or deals in cryptocurrency in any fashion. What are the basic tax implications of cryptocurrency? The government, at least for tax purposes, has classified cryptocurrency, Bitcoin, alt, light, etc., as property. Similar to owning shares of securities, stock, bonds, etc., this places onerous record-keeping requirements on those that invest or do business in cryptocurrency. Therefore, records need to be maintained in order to track the basis of each Bitcoin. However, the WAS sale rules likely do not apply to Bitcoins because they do not specifically meet the definition of a stock share. The government, at least for tax purposes, has classified cryptocurrency, Bitcoin, alt, light, etc., as property. Like trading in shares of stock and bonds, etc., requires fastidious record keeping to track your gains, losses, and basis, the same requirements are placed on you when you trade in cryptocurrency. A lot of uncertainty surrounds the taxation of cryptocurrency. The government's last publicized guidance on cryptocurrency as of the date of this taping was in 2014. Immediately after this guidance was given, the AICPA wrote a letter asking lots of questions about tax implications that weren't addressed. For instance, does 1031 apply? Can you do a like-kind exchange with different types of cryptocurrency? We'll cover that in depth later. It seems to be rational that the normal basis rules that apply to other types of property would apply to Bitcoin and cryptocurrency. Therefore, Bitcoin and cryptocurrency users should have the option to sell their assets on a first-in, first-out basis, on a last-in, first-out basis, or a selective cost basis method, maybe even average costing basis. In a rising market, LIFO, last-in, first-out, will produce the lowest tax liability. However, this may not get you long-term capital gain treatment. In order to get long-term capital gain treatment, which involve preferential tax rates versus ordinary income rates, which are usually higher, you have to sell a security that you've held for a year or longer. I'm going to use the word security in Bitcoin and cryptocurrency interchangeably because the SEC has defined cryptocurrency as a security. In a falling market, the FIFO method, first in, first out, will ordinarily produce the lowest tax liability. Taxpayers that are paid in Bitcoin, for services rendered or mining, those payments are subject to self-employment tax at ordinary income tax bracket rates. This means that if your net self-employment income is $100,000 or greater, you're going to pay 15.3% self-employment tax before you even begin to pay income taxes, state or federal. It also means that income will be taxed at the ordinary income tax brackets, not at the preferential capital gains rates. Businesses and individuals that make payments to anybody that isn't a corporation for the most part are subject to 1099 reporting requirements if they pay somebody over $600 in one tax year. Also, the backup withholding requirements could apply. i.e., if you were making payments to a non-resident alien, you may have to send backup withholding into the government. Recently, a bill was proposed that would create tax exemptions for cryptocurrency transactions under $600. This bill did not pass. The only guidance really issued to date regarding cryptocurrency, Bitcoin, etc., is found in Internal Revenue Bulletin 2014-16. In the bulletin, the IRS defines virtual currency as currency that can be used to acquire goods and services or held for investment. Actually, to date, it has almost any function that normal cash has. They define virtual currency as a digital representation of value used as a medium of exchange or to store value, and they admit that cryptocurrency has some functions like real currency of the US government and many other foreign jurisdictions. Cryptocurrency, while it functions like legal tender, does not, to this date, enjoy the legal status as legal tender in any jurisdiction within the United States or elsewhere. The bulletin defines convertible virtual currency, Bitcoin for example, as having an equivalent value to real currency and functions as a substitute for real currency and can be digitally exchanged between buyers and sellers, purchase via or exchanged into US dollars and many other foreign currencies. The common US federal tax consequences related to virtual currencies are as follows. At present, virtual currency does not generate foreign currency gain or loss when exchanged between countries. This is one of the advantages. A Bitcoin in US dollars has the same value as a Bitcoin in Chinese dollars. A taxpayer who receives virtual currencies for either goods or services must include the fair market value of the virtual currencies received in US dollars at the date of receipt. This is why record keeping is so important. If something is acquired with virtual currencies, the basis of that acquired asset is the fair market value in US dollars at the date of payment or receipt. When valuing virtual securities, look for an exchange that lists the market supply and demand and the changing fair market value on a daily basis of the security you're trying to value. Determine what that fair market value is on the date you're trying to come up with a valuation. Convert it to US dollars per coin at the applicable exchange rate, and this will most likely be considered a reasonable and consistent manner for valuation purposes. When cryptocurrency is exchanged for property, a capital gain or loss may have occurred. Where the fair market value of the property received exceeds the taxpayer's adjusted basis in the currency he spends on it, the virtual currency, the Bitcoin to cryptocurrency, the taxpayer has incurred a capital gain. Cryptocurrency is a capital asset. When you exchange it or sell it, you have capital gain or loss. The way to think about capital gains and losses are you have to look at holding period. If you've held it for a year or longer, you can enjoy the long-term capital gains rates, which are currently 0%, 5%, 10%, 15%, 20%, or 23.8%. Okay? All it takes is $250,000 of capital gain activity in 1 year to get into the highest capital gains rates, which are 23.8%. On the other hand, if you spend a Bitcoin or cryptocurrency that's been held for a year or less, any capital gain or loss will be short-term, and in that case, you look at it just as ordinary income subject to the normal tax brackets. The highest bracket for 2018, for example, is 37%, which is way in excess of 23.8% if it were the highest capital gain rate. California, by the way, doesn't make a distinction between long-term capital gains, short-term capital gains. Everything's taxed at the marginal bracket. Highest bracket is right around 13% for individuals. In contrast, a capital loss occurs where the fair market value of the property received is less than the adjusted basis of the cryptocurrency spent on the asset. The character of the gain or loss generally turns on the character of the virtual currency in the hands of the individual taxpayer, whether it's a capital asset in their hands or an ordinary asset in their hands. Okay? When you invest in cryptocurrency, you're going to get capital asset treatment. When cryptocurrency becomes inventory of a business, like in a money service business, all gains or losses are ordinary and no capital gain treatment will be extended. Again, virtual currency held as inventory in a trader business is not a capital asset. It will generate ordinary gains or losses. Where a taxpayer mines cryptocurrency, the fair market value of the virtual currency they receive at the time of receipt is includable in gross income, subject to self-employment taxes and ordinary income tax brackets, because it's really the provision of a service in exchange for compensation, similar to how people are paid on a 1099. This will be reported on Schedule C, and the reasonable expenses of generating that currency should be deductible against it. The hardware, the paper, the office expenses, those sort of expenses can be offset against the mining income on a Schedule C. Only the net income from that activity will be subject to self-employment taxes and ordinary income tax brackets. The fair market value of virtual currencies received as payment in the capacity as a subcontractor or an independent contractor constitutes self-employment income and is subject to self-employment tax, similar to how miners recognize income. Where an employee is paid in cryptocurrency, the fair market value of the virtual currency they're paid is wages and is subject to self-employment tax and federal income tax withholding and must be reported on Form W-2. Let me make this clear. All payments made in virtual currency are subject to identical information reporting as to any other payment that is made in property or in cash. Payments made in virtual currencies to foreign payees are also subject to backup withholding requirements, as are other payments made in property or cash to non-resident aliens. A business, an organization, and an individual that interacts with a substantial number of unrelated third parties can be deemed a money service business. A money service business functions to settle payments between various merchants, individual customers, or cryptocurrency investors. If you do this, you're likely to be seen as a third-party settlement organization or a money service business. The danger here is if you function as a money service business and you don't register with the SEC and state authorities as a money service business, you can face incarceration or civil penalties. If you're classified as a money service business, you will face all the regulation of a bank or maybe even as a securities brokerage. The Bank Secrecy Act, responsibility for looking for and reporting money laundering, suspicious activity reporting, and 8,300 reporting requirements where a transaction exceeds $10,000 in cash. Third-party settlement organizations are also subject to 1099-K reporting requirements. A 1099-K shows the total payments that are made to an individual merchant during a calendar year by party on a 1099-K. This allows the IRS to check, hey, is this third party reporting all of their cash transactions? They'll compare total sales reported, for example, on a retail organization to the sum of the 1099-Ks. If the 1099-Ks add up to 5 million, but there's only $3 million worth of sales, the government's going to go looking for $2 million of unreported sales. I happen to note that 1099-K reporting is done by most cryptocurrency organizations, where most other 1099 reporting is not done. It's been my experience that US-based coin brokerages ordinarily will do 1099-K reporting, but no other types of 1099 reporting like 1099-B for sales of cryptocurrency by individual investors. Underpayments related to virtual currency transactions on a tax return are also subject to accuracy-related penalties, just like cash transactions would be. Failures of businesses and investors to correctly report virtual currency transactions, where they are required to, will be subject to information reporting penalties found under Code Sections 6721 and 6722. The current uncertainty dealing with virtual currency is best illustrated by the following link that I provide in my handout materials to an AICPA request to the IRS for further guidance in this area. What is it about cryptocurrency in general that it's so likely to get me either audited or criminally investigated and potentially prosecuted for tax crimes? This is what I'm telling my clients about this subject. The IRS recently did a study where they went and looked at every return filed in the United States, and they searched those returns for the word cryptocurrency, Bitcoin, Ethereum, Lite, Alt, etc., looking for people if they were reporting their cryptocurrency transactions or not. Well, here's the results of that study. In 2013, only 807 individuals reported cryptocurrency-like transactions on Form 8949 using any type of a description related to Bitcoin, for example. In 2014, 893 individuals did it, and in 2015, 802 individuals did it. Well, there's over 210 million returns filed in this country a year, and it doesn't take a genius to figure out that folks that have cryptocurrency investments aren't reporting them. Well, that was frankly part of the allure of cryptocurrency in the beginning, is people believed that there was no way to assign or attach an identity to the cryptocurrency transactions. In other words, there was a blockchain ledger where all the transactions were recorded, but each individual owner of the individual coins represented by the ledger was given a numerical ID, and unless you knew what the numerical ID was of a person, you couldn't tell who was trading what. Matter of fact, I know from talking to several other of my clients that there's additional steps you can take to cloak your ownership of cryptocurrency. Well, the bottom line is the government decided, well, if people aren't voluntarily reporting cryptocurrency, what we're going to do is we're going to go to Coinbase and do something called the John Doe summons. Under that summons, anybody that had cryptocurrency investments that met the information requirement in the John Doe summons was supposed to be produced. As you know, Coinbase went to court and fought this, called the John Doe summons overbroad, basically prevailed, and it got narrowed down from a hell of a lot more people to just, I think 14,000 people in the nation wound up having transactions totaling more than 25,000 on Coinbase. So that information is being provided to the Department of Justice Income Tax Division. Their sole purpose in finding this information is to look for somebody to criminally investigate and prosecute for tax crimes related to cryptocurrency. Okay, having taxable sources of income and not reporting it on purpose is a crime called tax evasion. One way to get the herd to behave is to drag somebody out of the herd, slaughter them, and send the message to the rest of the herd, you don't want to be the guy who got slaughtered, report your cryptocurrency. So I'm here to tell you it's not as simple as just reporting on a go-forward basis your cryptocurrency transactions. What I hear all the time is, I'm just going to pretend 1031 applied and I'll recognize a gain in the year I actually sell this stuff, and I'm going to ignore everything in the meantime. That's a horrible idea, and we'll get into that a little later when I discuss why 1031 doesn't apply to cryptocurrency transactions. So the bottom line is I'm telling all my clients that in order to avoid either an audit or criminal prosecution, they need to report their cryptocurrency transactions in the year that they occurred and go back and fix prior non-compliance. It really comes down to how you're going to fix that prior non-compliance. Are you going to do that quietly just by amending returns through a service center and say something on the lines of, I didn't realize these crypto transactions were taxable. I didn't realize that if I mined Bitcoin and got paid for it, I was taxed on it. I didn't realize that if I spent an appreciated cryptocurrency that I was taxed on that appreciation. The problem is the IRS gave very distinct and clear guidance back in 2014 on a lot of this stuff. Granted, 1031 wasn't really covered, but a lot of the transactions that people are playing dumb about, we've had guidance ever since 2014 from the IRS. So the 14, 15, and 16 tax years can show a pattern of purposeful non-compliance if you're not in compliance with that guidance, okay? This is the reason that there's so much controversy surrounding investments in cryptocurrency and tax reporting. I could tell you this, if it turns out you owe an amount in excess of $30,000 on those prior year returns that you're going to have to amend, $30,000 under the sentencing guidelines is enough to get 1 year in jail if the government perceived your prior actions as purposeful and willful income tax evasion. I could tell you this, even if they believe you committed income tax evasion and the tax loss was less than $30,000, they're not quite as likely to prosecute because they're not going to get the headlines saying they at least sent you to jail for a year and a day. So I'm kind of using $30,000 as a dividing line as to when I think about going quiet and when I think about going loud, okay? Now, what's the difference between going quiet and going loud? Going quiet is just submitting tax returns to a service center and putting an explanation on it. Going loud is actually knocking on the door of the Criminal Investigation Division and saying, I'm bringing forth a client who you may believe acted criminally. I'm here to tell you I don't believe they did, but I know you might see that they acted criminally, therefore I'm bringing them into a domestic voluntary disclosure. What we have to do is amend 5 years worth of tax returns. If there's only problems on 3 of them, we'll give them 2 original returns and 3 amended returns. We'll have to submit to an audit. We'll have to pay the tax that should have been paid had true accurate returns been filed. We'll have to pay up to a 20% negligence penalty if the government believes you were negligent. You may have to pay up to a 75% fraud penalty if they believe you acted fraudulently. Let me explain how this works. If an amended return shows $1,000 worth of tax, with a negligence penalty you'd pay $1,200. With a fraud penalty you'd pay $1,750. Okay. All right. So that's loud versus quiet. You can read about this concept. It's called the domestic voluntary disclosure. You can search my website under those terms, domestic voluntary disclosure. It's basically a policy that says if you self-report your tax crimes, or what could be seen as tax crimes, voluntarily to us, you knock on our door before we knock on yours, we'll give you an nomine patri, forgiveness of your sins, and a pass on criminal prosecution. Okay? So if you have massive amounts of non-compliance concerning cryptocurrency, you might want to hire someone like me to put you into domestic voluntary disclosure, go back and fix the prior non-compliance with no fear of criminal prosecution, get right with the government, and that way when you go to fiat on this stuff and all of a sudden there's a $4 million deposit into your bank account and a report, 8300 report goes off to the US government that you've got a deposit in excess of $10,000. You might even get a suspicious activity reporting where, you know, the most amount of money you've ever had in your account was $10,000 and all of a sudden $4 million is plopped in there. You can bet your bottom dollar that there's going to be a suspicious activity report that goes off to the US government. There might even be a report of a suspicion of money laundering. Okay, you might even find that your bank doesn't want the deposit when they figure out it comes from cryptocurrency. A lot of banks are paranoid to take that deposit. Anyways, I can't suggest this more. If you have massive amounts of cryptocurrency non-compliance in prior years, go see a criminal tax defense attorney and deal with it. When is an 8949 required when reporting cryptocurrency? Generally speaking, when taxpayers have engaged in Bitcoin or cryptocurrency transactions, Form 8949 should be included along with the 1040 Schedule D. Per the instructions set forth on Schedule D, a taxpayer should use Form 8949 to report the sale or exchange of capital assets. Now this is important. Cryptocurrency can be seen as either a capital asset or an ordinary income asset. Okay, it's a capital asset if you're merely in an investing type activity. Okay, it becomes an ordinary asset when the cryptocurrency is seen as kind of like inventory in your business. You have to be careful that you don't engage in enough cryptocurrency transactions that the government starts to see your activity as rising from a passive activity, an investing activity, to an active activity, a trade or business activity, which is really two ends of a spectrum. On this end, not too many hours put into the activity. On this end of the spectrum, all your time put into the activity. The bad part about this is if you get ordinary gain or loss treatment, you're not going to get the benefit of the capital gains rates, which are lower. For 2018, the highest ordinary income tax bracket is going to be 37%. For 2018, the highest capital gain rate, I believe, is going to be 23.8%. At this point in time, it might be 20%. I'm not exactly sure whether the 3.8% add-on for Obamacare is still there or not at this point in time. Okay, so Form 8949 is used to report the sale or exchange of capital assets. These are defined later, okay? Virtual currency, like I said earlier, is most likely to qualify as a capital asset. The Schedule D instructions themselves already include virtual currency. It's an item for special treatment and directs people back to IRS 2014 Virtual Currency Publication, which was IRC Rev Proc 2014-16. Taxpayers that are considered currency dealers or otherwise hold out Bitcoin as inventory, mainly for sale to the public, are an example of individuals who hold Bitcoin as a non-capital asset. Most other taxpayers who hold Bitcoin or cryptocurrency do so in its capacity as a capital asset. Again, capital asset will produce capital gains and losses. An ordinary asset, inventory, will produce ordinary income. What are the current challenges in calculating your basis gains and losses in cryptocurrency? Currently, I can tell you that is a challenge to properly calculate our clients' basis gains and losses in cryptocurrency. This is for lots of various reasons. What we do is we ask our clients to go out to every brokerage they do business with and export the activity from that brokerage into a program called Bitcoin Tax. Within Bitcoin Tax, we attempt to do all the calculations we need to do. It keeps lots of information in Bitcoin Tax, and it's fairly helpful, but there are inherent problems. For example, the information being exported from the various brokerages is not uniform and may contain faulty assumptions. Coinbase, for example, makes the assumption that if you transfer a coin out of Coinbase that you've sold it. That may not necessarily be true. You may have exchanged it, and that's quite often the case for another cryptocurrency, but it doesn't give that in the same format when you look at their printouts of information. So you can't just go by Coinbase's representation of your gains, losses, and basis. Okay? It's more complicated than that. Also, most folks have been using lots and lots of different electronic coin brokerages. Okay? Some of those have gone out of business. Mt. Gox, for example. I'm finding it quite common that people have not kept all the records in a paper format. They counted on being able to rely on the electronic information out with Mt. Gox, for example, and lost all that information. In that case, we may be dealing with imperfect data, and we may have to resort to estimates to come up with numbers for a tax return. Well, it is legal to use estimates. It is not legal to not inform the government that you've used estimates. You have to let them know that you've used an estimate and disclose it. Now, that may draw an audit, but that audit will just be about whether they agree with that estimate or not. And that's a hell of a lot better than facing income tax evasion because you just chose to ignore the issue altogether. Okay? Most people that are invested in Bitcoin and virtual currencies will use an array of different wallets and different services. What a wallet is an electronic methodology that kind of like keeps a key to a lock. Okay? The blockchain ledger view it as a lock. The wallet viewed as a key. It is the individual information that allows an investor in cryptocurrency to get at the value of their individual coins. Those keys say, I own these coins, and you can't spend them unless you have the key to open the lock. While it's quite common for a taxpayer to use a variety of virtual currency services and have a variety of wallets, it becomes a challenge when you export all that information into Bitcoin Tax, for example. The data doesn't necessarily automatically jive, and the program doesn't necessarily give the calculations correctly. You have to go in and look at it. Frankly, the more transactions a client has engaged in, the longer it's going to take to get to an accurate answer. The first step in preparing a return that involves Bitcoin or cryptocurrency is to ensure that the gain or loss or basis information utilized by that client is accurate and properly reported on the return. Technically, each individual transaction should be input on Form 8949 and for each reportable event. Is it possible to do a 1031 where cryptocurrency is concerned? What I've seen time and time again is that individuals who are quick to recognize the opportunity presented by cryptocurrencies like Bitcoin, Dogecoin, and Ethereum have likely rode the market to significant gains. Okay? They've done that by when this currency is going up, they jump to that one, and when this currency is going up, they jump to that one, and when this one's falling, they jump to that one, and they basically day trade the heck out of this stuff. And most investors haven't realized that each one of those transactions was taxable in the year that it occurred. A lot of experts believe the rise in the markets was caused by capital in massive quantities being invested in cryptocurrency from China and other developing nations and flooding the market. Also, people who bought, sold, or mined Bitcoin or had an interest in the underlying technology, or just because they saw an investment opportunity, were looking to diversify their cryptocurrency holdings. So there's been a lot of these exchanges going on. In any case, A lot of people out there are considering changing the overall balance of their digital currencies held to increase the likelihood of investment gains or to hedge against potential volatility. In the only guidance to date put out by the IRS, the government called cryptocurrency in general property. They're saying it's not going to be treated as currency for tax purposes. Rather, Bitcoin and similar cryptocurrencies, again, should be considered property for tax purposes. Well, this raises the specter of, can Section 1031 be used when you change from one property to another? Well, let me make this clear. Starting in 2018, the government has limited the use of Code Section 1031 solely to real estate. So there's no question for the 2018 tax year and beyond, you can't use 1031 for this purpose. There's still an open question, could you use it to fix your prior non-compliance? I'm here to tell you in my professional opinion, no. Okay? I wrote a blog and I asked the entire planet of tax professionals out there whether they thought 1031 could apply. And what I basically boiled my decision down to, and frankly, there's two schools of thought on there. I know there's other attorneys out there that are using the benefits of 1031. I think that's potentially asking to be hit with income tax evasion, because to me the law is pretty clear. In order to use the benefit of 1031, two types of property have to be like-kind with each other. And the only party that could supply a definition of what like-kind is the IRS. Okay, they would have to put that into the Internal Revenue Code somewhere or the Treasury regulations, and that hasn't been done. There's no regulation out there that says every type of cryptocurrency out there is like-kind with every other type of cryptocurrency. There's no law that says that. So unless two properties are like-kind, you can't use 1031 to exchange between the two of them. The analogy that a lot of tax professionals came back to me when we were analyzing this issue is they said, look at foreign currency. If you were going from British pounds to US dollars, that's a taxable event, and you couldn't use 1031 because pounds and dollars are not like-kind. Another analogy is to look at stock. If you sell Boeing stock or you exchange Boeing stock without any cash changing hands for Coca-Cola stock, they're not like-kind with each other, and that's a taxable transaction even though no cash hit your hand. Like I said earlier, in practice, the government is a true arbiter of what assets are like-kind and what assets aren't. In a recent letter to the IRS that came out right after the 2014 guidance, the AICPA asked the service to provide guidance on whether varying types of cryptocurrency were like-kind for Section 1031 purposes. All we got back was crickets. The government never provided that information. And to be honest with you, the government allows 1031 when they're trying to encourage an activity. What they'd be saying to the world is, we want to encourage you to invest in cryptocurrency if they allowed 1031. There's lots of evidence out there that makes it appear the government is hostile towards cryptocurrency in general. So it's not likely that they will ever allow 1031 to be used. As an example of this hostility, recently the Treasury Department's Financial Crimes Enforcement Network, FinCEN, has cracked down on virtual currency exchanges that have not registered with the federal government as a money service business. This shows their hostility. People have been going to jail for this. Of the attorneys that say 1031 can be used, what you would have to do is you'd have to show each 1031 transaction on a return, and then you'd have to disclose that the use of 1031 was an uncertain tax position and draw the government's opinion to it. I think that's a patently bad idea. It could be that 3 years from now you get audited over that issue and they come looking for tax penalties and interest that have gone through the roof. Okay? Potentially, they could say you were just trying to squeeze that past their detection abilities and trying to commit income tax evasion, even though you fully disclosed it. There's a risk, maybe small, but there's still a risk. And really, depending upon the size of the numbers involved, determines how much risk there is. You need to understand that income tax evasion over $1 is the same crime as income tax evasion over $1 million. The only difference is the sentencing guidelines look to the amount of tax loss to the government in determining how much jail time will be served. With the uncertainty surrounding 1031, my position for our firm is that we're not going to utilize it. And because we're worried the government might clarify at some point in the future this issue, we're going to make protective refund claims over the returns that we pay tax where 1031 could have applied before the refund statute expires. What should you do if you all of a sudden realize that the Department of Justice Income Tax Division probably just received your information from Coinbase showing your trading history over the past few years in cryptocurrency? Well, the first thing to realize here, and I covered this in an earlier slide, is that the government knows as a whole Americans have not been reporting their cryptocurrency activity through the 2017 tax year. They're hoping something will change this year. That's the whole reason that the Department of Justice Income Tax Division issued the John Doe summons in the first place. They are looking to criminally prosecute somebody for their income tax evasion related to cryptocurrency. They want to send a message to everybody that's invested in cryptocurrency: don't you dare invest in this stuff, get rich and not report it for tax purposes. We will stick you in jail for income tax evasion. What I need you to realize here is that users of Bitcoin and other cryptocurrency brokerages who have failed to account for their capital gains, their ordinary income from mining, you could face criminal prosecution, civil fines, civil fraud penalty. There's a big downside here. If the government determines your non-compliance was based on a scheme to avoid or evade income taxes, the penalties are much harsher and may include a federal prison sentence. Also, a state prison sentence. What you need to realize, if you're one of the 14,000 people that Coinbase just provided information to the Department of Justice to, is the IRS will also obtain that information. The IRS and the Department of Justice have teamed together and used this tactic successfully to crack down on the fraudulent use of offshore credit cards, foreign accounts, foreign income generating entities, and generally to commit offshore income tax evasion. If you remember, UBS blew up because of a John Doe summons. In several subsequent enforcement proceedings against taxpayers, the John Doe summons was the first step in discovering the account holder's real-world identity. So, is there real criminal exposure if you have failed to report your prior year cryptocurrency non-compliance? Up until 2014, it was pretty understandable that you may not have understood how to report cryptocurrency transactions, or even may have had a duty to report cryptocurrency transactions. But in reality, if you really look at the Internal Revenue Code, Code 61 defines as income any accession to wealth. It is about as broad as imaginable, and that alone would pull in cryptocurrency gains. Nevertheless, many Bitcoin users were not aware that they were supposed to record their gains and losses as taxable events. They weren't realizing that they had a taxable event each time they made a purchase with the cryptocurrency, each time they sold cryptocurrency for fiat, for US dollars, each time they exchanged cryptocurrency for one type of cryptocurrency for another, Bitcoin to alt, to Lite, to Ethereum, etc. Or they may not have realized that when they mined cryptocurrency and got paid in cryptocurrency, that was subject to ordinary income tax rates and taxed as self-employment income, which means the first $100,000 of that income is going to generate 15.2% tax for self-employment tax alone. That's roughly $15,000 of tax on the first $100,000. But also keep in mind you can offset that by the expenses of generating that cryptocurrency income on Schedule C. What I need you to realize, because of the recent John Doe summonses that have been going out, you have risk for tax evasion. Okay, you can no longer choose to just hide and think that the government is not going to find you when you're invested in cryptocurrency. There was a lot of belief in the past that the use of cryptocurrency was undetectable. Matter of fact, there were internet websites where you could hire a prostitute, you could hire a hitman, you could buy drugs, you could do all this illegal activity, and the thought was that if you use cryptocurrency, that movement of wealth was untraceable. Okay? This is now false because of the use of John Doe summonses. Also, Eventually, when you come out of cryptocurrency and you deposit that money into an account, if you deposit more than $10,000, there's going to be a Form 8300 reporting that's going to go to the government to tell them that they deposited that. If that is a large, unusual transaction, there might be suspicious activity reporting. If the bank believes you're running a ransomware scheme where you're holding computers hostages in exchange for cryptocurrency, and this is illegal proceeds, they're going to send off suspicious activity reporting and possibly money laundering reporting to the federal government. If you're out of compliance, it could be as simple as just being subjected to civil penalties for failure to comply with tax laws. Underpayments attributable to virtual currency transactions can result in an accuracy-related penalty or information reporting penalties. However, penalty relief may be available to taxpayers and persons that are required to file an information return who can establish reasonable cause for not doing so. Examples: if you pay somebody more than $600 in cryptocurrency and they're not a corporation, you have to report that on a 1099. If you don't do so, you can literally be viewed as aiding and abetting the income tax evasion of the person you didn't issue the 1099 to. Worst case scenario, or they can hit you with a penalty for not issuing the 1099. Under audit, they can just disallow the expense because you didn't issue the 1099. Can a tax preparer have potential criminal liability where they counsel a client not to report their cryptocurrency? I actually got a phone call the other day from a potential client that told me the reason he hadn't filed returns reporting cryptocurrency in prior years is that his tax advisor had no idea how to report it. So they said, just ignore it. When you ultimately go to sell the stuff, we'll recognize gains at that time. I can't tell you how horrible that advice is. And matter of fact, reliance on a professional is grounds for penalty abatement. But imagine how this plays out. You put down as grounds for penalty abatement that your tax advisor told you not to report a taxable transaction. The government decides we're angry at that advisor for doing that and confronts them on it. The advisor lies through their teeth and says, no, he never told me about the cryptocurrency transactions. And now, instead of you getting abatement of penalties, you could face criminal prosecution because that would be a badge of fraud against you. Again, you have a conflict of interest with your preparer in this situation. So what type of liabilities do preparers have? Well, anytime a preparer advises a client to break the law on purpose, especially where that reduces the tax liability, they can be held liable for aiding and abetting the income tax evasion of another. They could be held liable for making a false statement on a return and a host of other criminal penalties. How would entering into a domestic or international voluntary disclosure help me fix my prior year cryptocurrency non-compliance? If you have several years of cryptocurrency non-compliance, okay, from as far back as possible 2009 forward, and there's large amounts of taxes that went unpaid, and there's lots of badges of fraud in your fact pattern. A badge of fraud is anything that if the government looked at it, they'd think you acted fraudulently because of that evidence, okay? Well, a pattern of non-compliance over a long period of time tends to establish willful behavior. Willful evasion of income taxes is a felony. It's 3 to 5 years in jail for each year it was done. There's a 5-year criminal statute or a 6-year statute, depending on which one they're relying on. And significant jail time could be involved in this. The good news is I have a way to fix it. There's a program, or let's call it a policy, because that's really what it is. The IRS has a policy. If you come forward to them and you admit your tax fraud, okay, before they've approached you, in other words, they had no idea there was a problem with your prior tax filings, you come forward, you admit that there's something wrong with your previous tax filings. It could be as serious as you openly and intended to commit tax fraud. If you come forward to them and admit it and set out to fix it, and make a true, accurate, and complete voluntary disclosure, you will get a pass on criminal prosecution. This is amazing, because think about it. If you murdered somebody, there's no government program to bring the body back to life and get an excuse for murder or get forgiven for murder. In nomine patria, I forgive you of your sins. But with tax fraud, this is possible. Now listen, This is not to be entered into lightly. This is a one-way decision. You need someone who understands this program to walk you through it. Okay, so how does it work? Well, it kind of goes like this. I go forward to the Internal Revenue Service, knock, 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 Criminal Investigation Division of the IRS. I'm bringing forward a client whose actions, if you looked at, you could potentially believe they were committing fraud. If possible, I'm going to argue, that if you really didn't have fraudulent intent, you may have been grossly negligent. But bottom line is this: even if you admitted to fraud, you get a pass on criminal prosecution if you use this program. So what's involved with that? The first thing I want to tell you is you need to be very careful. The person you go to for help can be your worst enemy. Think about it. CTEC certified folks, CPAs, enrolled agents, they don't have attorney-client privilege. They could literally be forced to testify against you under a court's contempt power. What can the court do to them? Sir, you're going to go sit in a jail cell for an indefinite period of time until you're willing to answer the court's questions. Sir, I'm going to fine you $5,000 a day until you start answering our questions. All within the court's contempt power. Believe me, they're going to sing. If you're a CPA, enrolled agent, or CTEC certified preparer, if someone walks in your office and they start talking about tax crimes, you need to kick them out of your office as soon as possible. Tell them to go see a tax attorney. If you haven't worked with this person before, tell them to tell the tax attorney they've got a relationship with this enrolled agent, CTEC certified, whatever. You can be involved as long as you don't know too much, okay? It's possible to associate in an accountant under something called an attorney's Covell relationship with an accountant. Under a case versus Covell versus the commissioner, long and short, it's already settled law that if somebody is providing a legal service to a client, helping a tax attorney, for example, quantify prior year possibly criminal noncompliance, that this is the provision of a legal service. And if there's a Covell relationship between the accountant and the attorney, or the preparer and the attorney, the accountant or the preparer can be under the same attorney-client privilege as the attorney has with the client. Although the very purpose of making a voluntary disclosure is to prevent prior year noncompliance from becoming a criminal tax issue, again, it's very important that a criminal tax defense attorney be brought into the case from the very beginning on lots of grounds, not just attorney-client privilege. Frankly, you need to understand this program inside and out, and I'm sorry, this isn't work that CPAs, EAs, and CTEC certified folks should be doing without the direction and control of working with, actually for, an attorney to serve as a client. The first thing that needs to happen is the attorney needs to make an assessment of a client's potential to be criminally prosecuted in the first place. If I come in and I look at a client's prior noncompliance and the amounts at issue are small and there are no badges of fraud in the fact pattern, I might be able to save that client from taking on the full expense and stress of making a voluntary disclosure by just recommending amended returns be submitted to a service center where I don't believe there really are badges of fraud in the fact pattern. In other words, I believe negligence caused the problem and not criminal intent. That is legal work. This is not something that EAs, CPAs, and CTEC certified preparers are trained to do. They're not trained to gauge somebody's criminal intent to their actions or whether they're willful or non-willful. That is attorney work. If you have somebody that's tried to do that for you that's not an attorney, they're basically practicing the unauthorized practice of law, and you could have their license. The first process in a voluntary disclosure is I send off a fax. If there's a married couple involved, it has both the names of the couple, it has their social security numbers, it has their birth dates, it has their address. Enough information for the government to identify these individuals positively, their social security numbers, and it asks a simple question: do these folks qualify to make a domestic voluntary disclosure, or if there's offshore issues, an offshore voluntary disclosure, sometimes both. It ordinarily takes the government 4, 6, 8 weeks sometimes to respond to this initial pre-check. They're going to come back and say one of two things. Yes, your client qualifies, in which case you can move forward with the voluntary disclosure, and in my opinion, they're as good as entered into the program, okay? Or no, your client doesn't qualify. If that happens, watch out. In the 2 times that's happened with one of my clients, the government was already criminally investigating them or something was going on in the background while they had information on them and they didn't qualify to make a domestic voluntary disclosure. Remember, we said that the only reason this works is you're approaching them before they know anything about you. If they're already looking at you in the background, even if you haven't received any mail, you may not qualify for this program. Do I really have to report my cryptocurrency activity? Isn't cryptocurrency really anonymous? I can't tell you how often my phone rings with a potential client on the line that is really just wanting to know one thing from me. How, if ever, is the government going to detect my cryptocurrency trading activity? Do I really have to report this for tax purposes? Do I really have to get in compliance with the law? You know, isn't this stuff anonymous? How the hell are they going to know about me? Okay, well, here's my answer. The first thing that I'll tell you is there's a certain amount of anonymity involved with cryptocurrency. Users' identities are protected to a certain extent, but not entirely. It's true that Bitcoin and most cryptocurrencies advertise that they are anonymous. The simple fact of the matter is that this anonymity generally refers to the fact that people can send and receive money without directly revealing any personally identifiable information. Unfortunately, far too many people misinterpret this last piece of information to believe that once money is in Bitcoin, it is invisible to the IRS and the US government. This simply is not true. This faulty assumption by yourself, or if you're a preparer watching this, your clients, can lead to an audit, civil or criminal enforcement action. I'm here to tell you that Bitcoin and other cryptocurrencies don't really provide perfect or even reasonable anonymity in many scenarios. Let me explain. Bitcoin and most cryptocurrencies function through the use of a public ledger that contains all transactions ever conducted in that underlying cryptocurrency, and this information is publicly available. Frankly, there's no such thing as an entirely private Bitcoin or any type of cryptocurrency transaction. Not Ethereum, not Lite, not alt. Any available anonymity stems from the fact that a user's identity is disassociated with the underlying publicly available information on the transaction. However, a record of the transaction time, the amount, and other information is always kept publicly available within the actual blockchain technology itself. The real problem exists with the government's use of John Doe summonses. There are other problems with detection, but let's focus on this one. When a user signs up with a popular cryptocurrency agency like Bitcoin, their identity is revealed in an email. That information is discoverable. For users that engage in Bitcoin transactions in this method, it is really no more anonymous or private than a banking transaction. You know what's really interesting to think about? That if I gave you a $20 bill, there would be no record of every other owner of that $20 bill. But if I give you a Bitcoin or Ethereum or Lite or alt, every person that has ever owned that cryptocurrency coin is buried in the underlying blockchain technology. The only thing that's missing is a dissociation between the transaction and who owns that transaction. It's kept by a numeric key. Once that key is associated with a human being, every transaction conducted by that human being is discoverable. Matter of fact, there are companies out there that are blockchain mining for the US government to identify this type of information. Even if the government doesn't associate you with a cryptocurrency transaction through a John Doe summons, when you go to fiat on that cryptocurrency, it's impossible to hide. Number one, you may find out that your bank doesn't want to accept a deposit if they find out it's related to cryptocurrency. You may find out that if you sold $2 million Bitcoin through Coinbase, that they place a $10,000 distribution limitation on your funds and they distribute it out at $10,000 a day. When you start making those daily deposits into your bank account, you could run into structuring accusations because you're depositing less than $10,000 because of the transaction fees involved. You could run into suspicious activity reporting, money laundering by the banking institution that accepts those funds. And all of this information is electronically transmitted to the IRS. Even if they never look at you because of the obvious signs that you're involved with cryptocurrency, what happens if the return that you failed to report cryptocurrency is audited at any time in the next 3 open tax years? Or, God forbid, 6 open tax years if they discover anything that pries open a 6-year statute, like a greater than 25% understatement of income, or, God forbid, fraud. If they discover you're not reporting your cryptocurrency in an open tax year, and they believe you did that willfully, they can pry open 6 years to look at, okay? And I can tell you this, that's ripe for handing off to the Criminal Investigation Division for prosecution if there's large dollar amounts involved. And let's face it, there are large dollar amounts involved here. I have clients that have invested all of $100 in cryptocurrency in 2010 that now have a paper value of 1.9 million. I have another client that invested $100,000 at the beginning of 2017 that's worth $22 million. The growth in this stuff is absolutely insane. The amount of meat on the bone for the government to come in looking for their piece is a hell of a lot of motivation for them to come look at your filings, okay? You need to report this stuff, and you need to report it in the proper year. You can't just stuff it all in the year that you go to fiat, okay? You're gonna have to go back and pick it up in the actual year where you have a taxable transaction. If you mine Bitcoin, you gotta go back to the year you mined it and you didn't pick up the income. Subject to ordinary income tax rates, subject to self-employment tax. If you ever spent a Bitcoin, if it appreciated between the time you bought it and the time you spent it, that's a taxable gain. It has to be recognized in the year you spent it, okay? If you exchange cryptocurrency, okay, let's say you bought one cryptocurrency, you bought one Bitcoin for $5 and then you changed it into an Ethereum at a time when that was worth $10. Well, that's a $5 gain that has to be recognized in the year you made the exchange. Okay, if you conducted 1 million exchanges, it doesn't matter. Each one of those exchanges is taxable. And the worst part of these exchanges is it resets the clock to go from short-term to long-term. So if you hold something a week and then you exchange it, hold it another week, and you exchange it, hold it another week, you're never getting into the long-term capital gains rates by holding something a year before you sell it or exchange it. What are the cryptocurrency FBAR and FACTA reporting obligations? If you've been living outside the United States and you kept your Bitcoin wallet outside the United States, or your cryptocurrency wallet outside the United States, or you've been engaging with transactions with offshore brokerages, coin brokerages, you could wind up facing a problem with non-reporting of the foreign account. At this point in time, it's not even exactly clear whether an offshore wallet or an offshore coin brokerage will result in an FBAR reporting. What's an FBAR? FBAR stands for Foreign Bank Account Reporting. And eventually, this definition is expanded to almost any type of financial account offshore. An investment account, all right? Back in 2014, there's only been one time where the government was approached and asked if they had to do an FBAR filing related to offshore wallets and offshore investments in cryptocurrency. And the answer was, well, at least for 2014, we're not requiring that information. There is absolutely no guidance for 15, 16, and now 17. What I tell my clients is this: there are no penalties for disclosing something you're not required to disclose on an FBAR. Unfortunately, if the government comes on later on and says, well, you should have disclosed that, there are penalties. What are the penalties? If they think you just were negligent, it's almost strict liability, there's a $10,000 penalty for not doing that form per year, okay? If they believe you were willful in not disclosing that foreign account, they can come after you for 50% of the high water mark of that foreign account over the year. So if for the entire year you had $1,000 in an account and then it went to $1 million, 50% of $1 million, even if it was $1 million for 2 seconds, okay? And frankly, it creates problems with how you fix it, okay? If you have these complications to your fact pattern, a domestic voluntary disclosure may not be enough. At this point in time, when I'm making this video, this issue is not clear. It may become clear in the future, but as of right now, nobody in the nation really has a clear idea on this. I'm hoping somebody at the IRS sees this and gives us some clarity, okay? If you have to do a domestic voluntary disclosure, it's no longer just about doing 5 years amended returns, picking up the tax you should have paid in the first place, paying a 20% negligence penalty, paying interest back to the original filing dates of the returns. Now the government may want up to 27.5% of the value of the cryptocurrency that was offshore in the wallet or offshore in the foreign brokerage. 27.5% of the high water mark over an 8-year period of time. Okay? An offshore voluntary disclosure is for 8 years, not 5 years. 8 years amended returns, 8 years of FBARs, 8-year period to assess an FBAR penalty on the high water mark of the total of all of the foreign accounts. If you have 20 of them, you add them all together, and on a daily basis over 8 years, which day had the highest balance in it, take that times 27.5%. That can be astronomical. The IRS has shown increasing ability to get at offshore financial institutions to get information. They went to the UBS and they got information on US account holders. Matter of fact, almost every bank in Switzerland has turned over information. They've gotten information from governments. I had a client where the US government went to the Indian government and said, give me all this information on offshore investments of this particular person, and sure enough, the government of India gave it to the US government. Okay? As time goes on, I think the government is going to take the battle against cryptocurrency offshore. Unfortunately, when we talk about cryptocurrency, there is a lot of uncertainty over a lot of issues. To be honest with you, the government's done a horrible job to date of providing guidance. The last time we got guidance was 2014. We're now in 2017. Questions are being asked all the time because the government is so short on resources, they're not providing answers. That leaves guys like me and your tax professional, whoever you're going to deal with, kind of guessing. But I like to be conservative. I like to take positions that are not going to turn around and bite my client or myself or hurt my errors and emissions insurance. One of the things we need to talk about are, what are the cryptocurrency FBAR and FACTA reporting obligations? Is it necessary to report for FACTA? Is it necessary to report for FBAR purposes? Well, let's start with this basic question. What do virtual currencies have to do with foreign accounts and taxes? Well, let's start by looking at a wallet. Okay, there's some confusion here. Users of cryptocurrency can either print out their full or their partial Bitcoin keys, if you will. All right, these are the special numbers that give them access to the coin that's carried on the blockchain ledger. They can carry that around in paper. All right, if they print out all these keys, if you will, and put them in their pocket and hop on a plane to Switzerland, does that mean they've got an offshore account because the keys to the cryptocurrency ledger are with them? Well, when you think about the cryptocurrency ledger itself, where is that? Where's the blockchain ledger at? Well, it's dispersed. It's all over the internet. It is in every country, in every corner of the world. So really, is it all foreign? Is it all domestic? We have no guidance at this point in time. So it's an open issue, left open to interpretation. Now look at it this way. You can carry around all of these keys electronically. How about in a flash drive, in a phone, in a laptop computer, on a hard drive, in the cloud, all right? Then the question becomes, where's that cloud located? The company that owns the server that your stuff is on is in Zimbabwe, but the server's in the United States. Does that make that foreign? These are all hair-splitting arguments that are going to be interesting to see how they resolve, okay? We need guidance. The next thing is this, okay, let's say you download, matter of fact, I had this happen once. I had a client put a flash drive in front of me. It was a specially designed flash drive to carry around cryptocurrency keys on it, okay? Literally, he put it on my desk and he told me what the value of that was. And anyways, it was just mind-boggling how much money was on this flash drive. Well, a flash drive, a phone, a laptop, what happens if somebody travels offshore and they take that with them? Does that create a foreign bank account reporting? What if they were only offshore for 10 minutes? They went to Mexico, they had a soda, and they came back. Does that create an FBAR reporting? We need guidance. These are open questions. I don't really even have the answers for you, all right? To make things even more complicated, the location of this electronic wallet can be determined by the location of the hardware, okay, the hard drive, the phone, the flash drive, or it can be determined by the brokerage that the client is doing business with. Well, it seems to me it becomes a little bit more clear. If they're dealing with an offshore brokerage, that already kind of raises offshore compliance issues. And if the keys are kept with that brokerage that's offshore, it starts to lean towards disclosing. I still can't tell you whether that's right or wrong, but I can tell you this. If you disclose and you weren't required to, there's no penalties for that. But if you don't disclose and it turns out you were required to, you could face civil and possibly even criminal penalties. The distinction I just mentioned is important because when we look at hard currency, when we look at real estate, when we look at precious metals, if we look at personal property that's held directly by somebody, certain covered benefit programs, these are not reportable for purposes of the FBAR or FACTA. We could possibly argue in that way. But look at this. Once these very assets, okay, where they have given guidance, precious metals, for example, if you take precious metals and you put them in a lockbox, a security box, and you stick that with a foreign institution, all of a sudden that becomes reportable on the FBAR, okay? Once these assets are placed in a foreign financial account, they become reportable for purposes of the FBAR and FACTA. I think by analogy, you could say the same thing applies to cryptocurrency. The bottom line here is some users of Bitcoin, for an example, can place the value of their Bitcoin in an account that may be held overseas, or they can store it, trade it with a foreign exchange. To me, this seems to be an area of some concern. So what, if any, guidance has the government provided on this FBAR versus FACTA issue involving cryptocurrency? In 2014, Rod Lundquist, a senior program analyst for the Small Business Self-Employed Division, indicated that for 2014 only, the IRS would not be requiring Bitcoin to be reported as part of an FBAR. He elaborated by adding that FinCEN has said that virtual currency is not going to be reportable on the FBAR, at least for this filing season. Emphasis added. The IRS later clarified this statement when queried by a reporter. It clarified that virtual currency accounts also fell under the non-reportable guidance. Despite the unofficial nature of this guidance as to 2014 only, this is still the only statement to date that taxpayers must guide their offshore account reporting by. Again, this statement was explicitly limited to the context of a single filing tax year. Unfortunately, recent enforcement actions taken by the IRS and the Department of Justice may suggest the possibility that the IRS is reconsidering this approach to Bitcoin and foreign account information disclosures. Let me explain. I think it would behoove taxpayers to align their handling of cryptocurrency reporting with that of gold, hard currency, and real estate. That is, these assets are generally not reportable for foreign account purposes when held directly by the taxpayer, but they become reportable when they are stored in a foreign financial account. Under this approach, under this logic, not that I'm saying this is guaranteed, but it seems logical that a taxpayer who carries around a printed Bitcoin wallet would not need to report that Bitcoin or cryptocurrency wallet for purposes of an FBAR or FACTA. On the other hand, a taxpayer who has placed the value of her Bitcoin or other cryptocurrency in a virtual wallet that's hosted overseas, potentially at that point you should begin to include this for purposes of aggregating and reporting on your offshore accounts. This approach would, at least in theory, provide the taxpayer with some reasonable approach to an unsettled tax issue. To wrap this up, when in doubt, disclose. Again, there are no penalties for telling them about cryptocurrency transactions offshore on an FBAR or FACTA, even if you're wrong in doing so. But if it turns out you were required to and you don't do it, you could face substantial penalties. Another area of potential contention or uncertainty involving cryptocurrency is how do you value it? To date, there is no official valuation authority for Bitcoin and most other virtual currencies. Instead, various websites across the internet update exchange rates throughout the day. As of the date of this filming, if you were to do a simple Google search, you would soon realize that there are several different ways to value Bitcoin on several different websites. Each website can have a different valuation as of the same time period. This makes it extremely difficult for a taxpayer to measure the value of their virtual currencies at the time of their disposition. To complicate matters, taxpayers have not received guidance as to whether averaging valuations is appropriate. In other words, should you take 3 different websites' valuation and average the 3 of them? Another area of uncertainty is about how you value property, cryptocurrency considered property. Can you use the average cost basis? Can you use last in, first out? Can you use first in, first out? Can you use specific identification? In other words, I want to specifically identify the individual coins that I'm selling because I want the highest basis and the longest holding period to reduce the tax effect of that transaction. That's fair when you're talking about stocks and bonds. Is it kosher with cryptocurrency? What my firm is doing is whatever valuation method we use it consistently, and then we disclose the use of that valuation method as an uncertain tax position on the return. This may not avert an audit where the government comes in and has a different opinion, but if additional penalties and interest come out of an audit, it is at least grounds for penalty abatement that we disclose the uncertain tax position. The first thing I need to tell you about the regulatory environment over cryptocurrency in general is that it's in a state of flux. Each state in the Union will eventually address the issue of cryptocurrency within that state. Some states have addressed it, some states haven't. The federal government itself will be regulating as to cryptocurrency. I can tell you, as of the date of the filming of this video, the state that seems to be most open to emerging technology and cryptocurrency is New York. I would say New York's regulations over cryptocurrency establish the best practices of, if you're going to be in this uncertain space from a regulatory perspective, these are the best practices to make sure that you have the least amount of chance of being fired upon by the federal government or the state government. Unfortunately, nobody can guarantee you that you won't be shot at. What I can tell you in the next breath, as of the date of the shooting of this video, is that simple one-on-one investing in cryptocurrency, one individual investor buying and selling securities, cryptocurrencies, through coin brokerages, appears to be a safe activity that doesn't lead to criminal liability as long as you report the tax ramifications of it. And number 2, as long as you're using legal source income to do it. Why do I mention legal source income? Well, one of the reasons there's a stink coming off cryptocurrency is how it came into being. At one point in time, cryptocurrency was thought and believed to be completely anonymous. Okay? Matter of fact, there were websites where you could hire a hitman, you could arrange a date with a prostitute, you could buy drugs, and what kept it anonymous is the use of cryptocurrency in doing that, so the government couldn't trace the source of the funds to buy the illegal service or the illegal goods. Unfortunately, cryptocurrency is thought to be used to some extent for money laundering. Matter of fact, right now there are ransomware attacks going on where the only way you can pay the person who's locked down your computer is with the use of cryptocurrency. The cold hard fact of the matter is that cryptocurrencies appear to be here to stay. The blockchain technology has many uses outside of just cryptocurrency. Matter of fact, I hear that the banking industry is starting to embrace this technology as a way of doing wire transfers. Cryptocurrency investment is reaching record levels with massive amounts of money being invested into this technology on a daily basis. Unfortunately, we don't have just one cryptocurrency outfit anymore, Bitcoin. There are, to date, over 1,100 of them worldwide. Matter of fact, I've had high school seniors that are good at computers with no education whatsoever come to me wanting to do initial coin offering and offer their own cryptocurrency. I hear major corporations are trying to issue their own cryptocurrency. Unfortunately, all this cryptocurrency activity is creating exposure for regulation surrounding security breaches, money laundering concerns, banking privacy, Bank Secrecy Act, SEC regulations. It goes on and on. FinCEN. Everybody wants to regulate this stuff, and frankly, what regulations are they looking at? They're looking at the existing regulations for banks and the existing regulations for security brokerages. These regulations weren't written with cryptocurrency in mind. Recent documents released this summer by the SEC, other U.S. regulatory agencies, have thrown new light on how Bitcoin and other cryptocurrency and blockchain currencies could possibly be regulated going forward. One way of looking at how the regulatory environment surrounding cryptocurrency is evolving is to look at how the individual states are passing laws that address blockchain technology and cryptocurrency technology. For example, in Washington state, virtual currencies are included in the definition of money transmission in the Uniform Money Services Act. This is interesting because most people are thinking because the IRS called cryptocurrency property that we don't have to worry about securities laws, we don't have to worry about money laws, banking laws. It's property. I'm sorry, for tax purposes it's property. These other government agencies and state agencies are seeing it function and treating it quite a bit like regular currency or wire transfers. In Washington state, companies wishing to transmit money or value via cryptocurrency to Washington state residents must contact the Washington Department of Finance and get a determination if licensing under the Uniform Money Services Act is required. If so, this requires a license. In California, AB 1326 surrounding digital currency was recently proposed. This act, if it would have passed, would have required registering with the California Commission of Business Oversight to be considered, or you'd have to be considered to be exempt under the California Money Transmission Act. The state was going to require a bond set by the state. The act created a digital currency business enrollment program, and it granted this agency the power to regulate digital currency in California. The bill prohibited the engaging in digital currency business without enrolling in the DCBEP or via conducting business through an unenrolled agent. Fingerprints were going to be required for everybody involved in this activity. Anybody associated with the activity was required to be of good character in order to receive a license. They were also going to be required to provide audited financial statements on an annual basis. Unfortunately, this act did not go through, and to my knowledge, as of the date of this filming, no regulation over cryptocurrency really exists in California. As I said earlier, New York seems to have the most pro-cryptocurrency regulatory environment of all the states. Quite possibly that's because Wall Street is located in New York, and Wall Street recently seems to be embracing cryptocurrency transactions, where currently they seem to be in the process of making commodities trading possible around cryptocurrency, where you can short it or long it. In New York, regulation of virtual currency, cryptocurrency, is under the Superintendent of Financial Services. New York's regulations define a virtual currency business as having the following types of activities: receiving or transmitting virtual currency, and they give an exception where the transmission is for non-financial purposes or where nominal value is at issue. Storing or holding virtual currency for others. Buying and selling virtual currencies as a business. Controlling, administering, or issuing a virtual currency. Putting an ICO out there, for example. Initial coin offering. In New York, you can't run a virtual currency business without first obtaining a license. Merchants and consumers that utilize virtual currency as a means to sell or purchase goods or for simple investment purposes are exempt from licensing requirements. Each licensee in New York is required to maintain and enforce a written policy designed to prevent fraud, money laundering, provide cybersecurity, privacy, and information security. The maintenance of a specified amount of capital is required by the state of New York. A cryptocurrency company must submit to examination by the state of New York if they request it. As I've said earlier, New York's BIT licensing program is probably a good place to start for best practices and compliance requirements for a cryptocurrency outfit that's doing business outside of the state, especially in a state that has no regulation at all. Also, these regulations kind of harken back to federal regulatory concerns, not that it meets it. There are plenty of examples when it comes to federal regulation of cryptocurrency that the federal government is on many levels hostile towards it. For example, in September 2016, TICTA issued a report titled, "As the use of virtual currencies in taxable transactions becomes more common, additional actions are needed to ensure taxpayer compliance." The reference number of this is 2016-30-083. It was published on September 21st, 2016. In the report, TICTA recognized that the use of cryptocurrencies, the investment, the trading in cryptocurrencies, had expanded dramatically. The report points out, while there are many legitimate uses of cryptocurrency, one of them is simply for investment purposes, that some taxpayers are attracted to the ostensible anonymity of the platform and therefore pose a problem. The report reflects TICTA's expectation that there are legitimate reasons to use or invest in virtual currency. It points out that some taxpayers are attracted to cryptocurrency by the ostensible anonymity of it, and that could be a problem. TICTA believes, and so do many other factions of the US government, that there are people that are attracted to this sense of anonymity because they wish to engage in illegal acts or transactions, including tax evasion. The report concluded that the IRS to date had failed to coordinate, and none of these individual divisions of the IRS had put together compliance initiatives, guidance for conducting examinations or investigations specific to tax compliance related to virtual currencies. One of the reasons we have so much uncertainty as tax professionals how to report cryptocurrency, by the way. TICTA recommended to the IRS that they develop a coordinated virtual currency strategy to identify and prosecute this emerging form of tax evasion through the use of cryptocurrency. By watching the news lately, it's very apparent that the IRS is implementing this strategy as we speak. More recently, in June of 2017, the House of Representatives Financial Services Committee heard testimony from a panel regarding the potential dangers of cryptocurrency. The expert panel discussed how cryptocurrency can be used to perpetuate crimes and how even national security can be placed in jeopardy because of the existence of the cryptocurrency market. For example, the testimony focused on the use of cryptocurrency with ransomware viruses. These viruses have been circulated around the internet for a long period of time. They have relied on cryptocurrency to hide the transmission of funds to the ultimate recipient and the person committing that crime. They've used Bitcoin for the most part to be the exclusive currency to pay the ransom in order to retrieve their data back that they've been holding digitally hostage. A common misconception among those who use Bitcoin and other virtual currencies as part of criminal activities is that this is a trace-free way to transfer money or to make purchases. Matter of fact, one of the theories floating around about why the value of cryptocurrency has gone through the roof is that organized crime is utilizing cryptocurrency to money launder. Imagine if you shipped a bunch of drugs from one country to another, would you rather get a couple truckloads of cash back, or would you rather get a flash drive with $3 billion on it? In reality, cryptocurrency is becoming one of the most traceable ways to conduct business. Startup companies like Elliptic, for example, are currently working with law enforcement to track the identities of people engaging in transactions using cryptocurrency that are believed to be involved with money laundering or criminal activity. What this really means is that transfers and conversions of cryptocurrency may be held to the same standards as other securities, including stocks and bonds, that the SEC has customarily overseen. In my opinion, you can't do an initial coin offering without first registering that coin offering with the SEC because you're offering a security to the public. If you don't do this, in my opinion, you could and will violate federal law. Frankly, I'll be honest with you. I've had people come in my office looking for guidance on how to do an initial coin offering. What I've told these folks is that I'm a tax attorney and I'm not qualified as nearly a sole proprietor and a tax specialist, tax is my wheelhouse, to really opine on the regulatory environment and how to do certain things legally. Right now, I was approached just earlier today, asked, how can I trade cryptocurrencies on the behalf of third parties? I want to take other people's money. I've been so successful in cryptocurrency investing. I want to invest it on their behalf and get paid for that service. Well, frankly, I don't think you can do that legally. I think what winds up happening is you'll get classified as a money service business because you're conducting money transactions for third parties. And if you don't register with the SEC as a money service business, you could find yourself facing criminal prosecution for that. The SEC's choosing to regulate cryptocurrency as a security means probably the following. The SEC may require registering coin sales as a sale or exchange of a security and regulate it as such. All cryptocurrency tokens, digital currency, may have to be registered and follow SEC regulation unless they fall into some sort of an exemption. Most of the people I've been talking to that are getting involved with ICOs seem to be finding a way around SEC regulation. Matter of fact, I don't know how you can even put a cryptocurrency out there without breaking the law, based on my understanding of the law. But this isn't really my area of specialty. Any professional or investment managers that deal in cryptocurrency must be appropriately registered or licensed. Failing to follow SEC regulations could put you or your clients at risk of regulatory enforcement. This could result in penalties or effectively prevent additional transactions. In worst case scenarios, purposely failing to follow SEC regulations could be charged criminally. Offering cryptocurrency for sale to the general public without first registering with the SEC, this could result in a charge of securities fraud. This could be criminally prosecuted. Simply creating an online portal through which the public can transact transactions involving cryptocurrency without first registering this business or service as a broker-dealer or stock exchange could be criminally prosecuted. There are some arguments that cryptocurrency itself is not a security. Unfortunately, the entities that own or trade virtual securities require registration with the SEC. Simply providing a return based on investments in digital securities qualifies as security for SEC regulation purposes. The SEC demonstrates its concern over this issue by forming a multi-office digital currencies working group. They did this on 8/30/13, and at that time it had 50 SEC agents assigned to it. The big issues with the government as far as cryptocurrency is concerned is money laundering, Ponzi schemes. Matter of fact, the SEC has gone so far as to warn the public not to invest in cryptocurrency because in their opinion it's a Ponzi scheme. Other concerns are unregistered securities with the SEC and securities fraud. More signs of trouble for cryptocurrency is that the U.S. Department of Justice has formed a global illicit finance team. GIFT is the acronym. This team consists of investigators from the U.S. Attorney's Office, the Secret Service, Immigrations and Customs, the Department of Justice Asset Forfeiture Division, and money laundering sections. This is big time. All of this says it looks like the U.S. government at some point, if they're not already, is going to go to war with cryptocurrency. GIFT was already responsible for shutting down Liberty Reserve. This was a cryptocurrency company that had $6 billion in currency, and it was proven that it was used to aid and abet money laundering.